Stocks tried to rebound earlier in the session but are now flat. Joining me today is Joseph Greco from Meridian Equity Partners to talk about how stocks are performing right now, as well as what to expect on next week's economic calendar. Thank you again for joining me. It's always a pleasure.
Thanks for having me.
So obviously there's been a lot of volatility over the last 2 days after the Fed statement, which is surprising because they really didn't say too much that was new. How has it gone so far in today's session?
Well, being that everyone is so focused on what the Fed's saying, you're right, it's not really necessarily new information, but actually hearing it so definitively really does have some impact. So the actualities are, of course, that Bernanke and the Fed presidents altogether are focused on, at some point, slowing the pace of asset purchasing. That's the first thing. They'd like to do it sooner than later. Two, Bernanke made very clear, not only when they do stop, could they potentially hold these positions, but they're not necessarily going to sell right away. So he wanted to direct that concern that all of a sudden, the minute they stop buying, they're going to turn seller and depress the entire market. So that's not the case either. But it does give pause for people who are long this market, up double digits so far this year. Is now the time to take a little risk off the table before the market goes down a few percent points and now everyone else is taking money off and you're late to the game. So I think at this point people are starting to recognize summer's upon us. We've been through a great first half and a great run thus far. Perhaps delever a little bit, go into each weekend with a little less exposure and then recalculate as the weeks come on.
Now, moving on to next week's economic calendar, we are going to see a lot. So starting with the durable goods orders, we haven't exactly seen year-over-year growth. It kind of had a spike after the financial crisis, but we really haven't seen year-over-year growth since then. So if the Fed does begin to start scaling back on stimulus like they kind of are hinting at, is that really what we will see if the economy can sustain itself rather than the Fed intervening with their QE program?
Well, as you pointed out, immediately after the crisis, the real blow, of course, there was a pretty nice improvement right away, and that's because of such a sharp sell-off in production just prior. Where we're at now is a very, very gradual and slow, and sometimes even a negative, pace at which the economy is recovering. Durable goods and all the other metrics that we look at aren't, gangbuster quarter after quarter or even month after month. So at this point, I wouldn't be so concerned that, the pullback of government stimulus is going to have an immediate impact on durable goods or vice versa. What I am concerned is that after 1 month, 1 quarter, half a year of the government slowing asset purchasing and perhaps even ceasing altogether, what happens then? So we're, that's pushing out to well into 2015 at this point. I think more short term we need to look at, not the, 20 bips or 25 bip move in a rate, but the bigger, moves that could potentially come if the government is very abrupt.
We also will see the Core PCE price index next week, which actually hit its lowest level in April, and the Fed does use that as a big indicator for inflation. Now, is there fear that the economy might start entering a deflationary environment? Because with QE, we were supposed to see more hyperinflation, but we're not exactly seeing that now.
Sure. We're not. To break it down in layman's terms, right? They printed a ton of money and it's not anywhere to be seen. You're not seeing money being spent on the streets, that's for sure. So the people who are recipients of that capital are at the very highest levels of the financial institutions right now. The lending hasn't started to become, very, loose just yet. We haven't seen, credit being expanded. We've seen people reducing their credits on the household level, and that's good. We've seen consumers return in waves seasonally, but not necessarily, sustainably across the year. So all of that stuff factors in. I don't necessarily think we're going to see a rapid improvement or a real sharp, hit to CPI just yet. I think inflation will absolutely take hold at some point because all that money that's been injected into the system is going to start to be spread out. And when that does, if I'm willing to pay more for that pizza than you are, and I'm really hungry, it's going to be mine. So.
Personal income is also being released next week, and it really has remained at the same sort of level. So when it comes to the wealth effect, as we've seen equity prices rise and housing prices rise earlier this year, how long can that actually last if wages do just remain at that same level?
Sure. I mean, we all know, on the corporate level, on the personal level, we're doing a lot more with a whole lot less. And people aren't working more, but they are earning at least the same, but it's considerably less than they were accustomed to. And now we've had, a year or 2 years almost of digesting that and seeing no gains. We're earning the same. There is no built-in cost of living improvement unless you're, a civil servant. So at this point, I am a little concerned that data is going to be, the negative one that's going to really push us backward instead of allow us to continue forward. And I think ultimately that's going to be data that goes hand in hand with the unemployment rate, goes hand in hand with the non-farm payrolls, and then of course the ultimate decision of the Fed to step away, because that's one of the two biggest metrics that they're looking at, and what the unemployment situation is. So personal income, very important to the economy right now.
And finally, we will see first quarter GDP revised again, and it did edge down slightly from the 2.5% to 2.4 the last time. Should we expect to see any sort of changes based on any of the data we have seen since the last revision?
Well, full disclosure, I'm not an economist. I don't have spreadsheets that, guesstimate where this is going to be. I would think that there's going to be a 10 to 20 bip move either way. So, I think it's going to stay in a very tight range. We don't see very many trade imbalances going on. We don't see any spike up or down in demand or consumption from our trade partners around the world, even though there are some fears out of China, and Europe obviously has some, of their own issues right now with their economic recovery. We're not seeing, immediate fall off in sales, or obviously spike in sales, which would help us out.